When most people, when they think about holding a garage sale, there's this very specific, almost kind of visceral image that comes to mind.
Oh, absolutely. The classic Saturday morning setup.
Right. You're waking up at like 6 in the morning on a weekend.
Yeah.
You're dragging these heavy folding tables out onto a damp driveway, slapping little neon price stickers on, I don't know, old paperbacks or a slightly dented toaster.
And basically just standing there.
Yeah. Just standing there drinking lukewarm coffee, hoping that someone driving by is willing to hand you $2 crumpled for something you haven't touched in 5 years. It's just chaotic.
It's chaotic, it's intensely local, and honestly, it's entirely based on the blind chance of who happens to drive past your house.
Exactly. It's the ultimate exercise in friction.
You're severely limited by your geography, the weather, and just the sheer randomness of foot traffic.
But imagine if you could take that exact same foundational concept, selling something you own to another person.
Yeah.
And completely remove the damp driveway from the equation.
Just totally digitize it.
Right. Instead, you're standing inside this sleek, highly secure global auction house. So instead of hoping a neighbor wants your old toaster, you're instantly, seamlessly connected to a collector in Tokyo.
A collector who has been searching for your exact vintage watch for a decade.
Yes. And they're willing to pay top dollar. It's no longer a yard sale. It's evolved into this highly optimized, high-margin global exchange. And that brings us to what we're doing here today.
Yeah, we're taking a different approach for this deep dive.
We are. We're employing our Talk Tickers framework for you guys listening. The mission today is to take an official corporate earnings call, specifically eBay, ticker symbol EBAY, for their first quarter of 2026. And we're going to strip away the Wall Street analyst jargon.
Which is always a lot of fun.
Always. We're going to look at the hard data, figure out what's driving those numbers, and give you an actionable, opinionated bottom line on what it means for the retail investor right now. Because honestly, navigating this current e-commerce landscape is very strange.
It really is. And the overarching narrative we need to keep in focus today is one of strategic evolution. I mean, we're evaluating a company that a huge portion of the public still mistakenly associates with, like the dial-up era of the late 1990s.
For sure. The whole Beanie Baby craze.
Right. But if you look at the transcript from this April 29th call, they have completely re-engineered their DNA. And this is happening against a 2026 macroeconomic backdrop that is, frankly, just unforgiving.
Yeah, consumer sentiment is wobbling. Inflation is still stubbornly lingering in certain sectors.
It won't go away.
It really won't. And yet we're looking at numbers here that suggest a company entirely insulated from those headwinds. So let's pull up the raw data, because the scoreboard here is genuinely surprising.
It's a massive beat.
It really is. We have 4 headline metrics from Q1. First, gross merchandise volume, or GMV, rose 14% to $22.2 billion. And that's listed as organic, FX neutral.
Right.
Second, revenue grew 17% to $3.09 billion. Third, non-GAAP operating income jumped 18% to $907 million.
A huge jump.
Huge. And finally, non-GAAP earnings per share increased 21% to $1.66. But before we look at why these numbers are so high, we need to do some jargon translation for you guys.
Let's do it.
Let's start with organic, FX neutral. What does that actually mean when an investor reads it on a press release?
Well, organic basically means we're looking at the core business's growth, right? We're stripping out any artificial boosts from recent acquisitions or, hits from selling off a division.
So it's just the core engine.
Exactly. It tells us the underlying engine is actually running faster. And then FX neutral stands for foreign exchange neutral, because eBay operates globally, right?
Right.
So if a buyer in Europe purchases a jacket from a seller in the US, that transaction involves euros and dollars. If the euro weakens against the dollar over the course of the year, eBay's revenue in Europe might look lower on paper when converted back to US dollars.
Even if they sold the exact same number of jackets.
Precisely. So reporting it as FX neutral just removes that distortion of currency fluctuations. It lets us see the true volume of commerce actually taking place.
Okay, that clarifies the top line. Now, what about non-GAAP? Because they use that to describe both operating income and earnings per share.
Yeah, so GAAP stands for Generally Accepted Accounting Principles. It's basically the standard rule book for accounting.
The official legal numbers.
Right. So non-GAAP means the company has adjusted those official numbers to exclude certain one-time or non-operational costs.
Like what, for example?
Usually this means stripping out things like stock-based compensation given to employees, or maybe the amortization of intangible assets from past acquisitions.
Okay, so it's smoothing out the weird accounting bumps.
Yeah, exactly. While you always want to keep an eye on the GAAP numbers to see the strict legal reality, Wall Street often prefers non-GAAP because it just gives a clearer picture of how much cash the core day-to-day business is actually generating.
Okay, that makes the 21% jump in earnings per share much more tangible. Now, I want to look at the relationship between those first two numbers we mentioned, the gross merchandise volume and the revenue.
This is where it gets really interesting.
It is. Because, okay, GMV is the total dollar value of all the physical stuff being bought and sold on the platform. Every single trading card, every car part, every handbag. And that total value hit $22.2 billion in just 3 months.
But crucially, eBay doesn't keep that $22.2 billion.
Right. That money goes to the sellers. Revenue, on the other hand, is the slice of the pie eBay actually extracts for facilitating the transaction. And the revenue slice was $3.09 billion.
Which introduces one of the most critical metrics for any marketplace business model, right? The take rate.
Yes, the take rate.
If you divide their $3.09 billion in revenue by the $22.2 billion in total volume, you get a take rate of 13.9%. That's the percentage of every dollar flowing through the ecosystem that eBay captures.
Okay, 13.9%. But yeah, the most revealing detail in these headline numbers is the growth disparity. Did you notice that the total volume of goods sold grew by 14%, but the revenue eBay kept grew by 17%?
It's a massive bullish signal.
It is. And it suggests they're taking a larger cut. But are they simply jacking up the fees on their sellers? Because historically, when a platform just indiscriminately raises transaction fees, sellers eventually revolt, right? They just leave for a competitor.
That is always the risk. But the transcript reveals a totally different mechanism at play here. Their chief financial officer, Peggy Alford, specifically broke down where that extra revenue is coming from.
And it wasn't just blanket fee hikes.
No, not at all. The primary driver is actually their advertising business. Total advertising revenue hit $581 million in the quarter.
Wow.
Yeah, and their first-party ads, meaning sellers paying eBay directly for prominent placement on the search results page, that grew 28%.
Wait, so out of the $3 billion in revenue, over $500 million is just sellers paying to promote their listings?
Yes. Out of the roughly 2.5 billion total listings on the platform, over 1.2 billion are utilizing promoted listings.
That's almost half.
It's huge. Over 5 million individual sellers used an ad product just this quarter.
Okay, so when a seller voluntarily opts to pay an extra, 2% or 5% to have their listing appear at the top of a search result, eBay's take rate naturally expands.
Exactly. They are monetizing the competition between sellers rather than just raising the baseline toll for everyone.
That's incredibly smart. But I want to push back on the health of the underlying ecosystem for a second.
Okay, let's hear it.
Because as I was reading the active buyer metrics that Alford laid out, this glaring contradiction just jumped right off the page.
The 1% number.
Yes. Global active buyers only grew by 1%. They're hovering at nearly 136 million trailing 12-month active buyers. If the total number of human beings buying things on this platform is basically flatlined at 1% growth, how on earth is the revenue up 17%?
It seems like a disconnect.
It does. It sounds suspiciously like a company just bleeding a stagnant user base dry. I mean, is that a sustainable business model?
That is the most important question to ask. And honestly, it was the very first thing an analyst from Bernstein brought up during the Q&A session.
Well,
because a 1% user growth rate for a tech platform usually signals a plateau. You're dead in the water. But you have to look at the composition of those users, not just the raw head count.
Right.
Management's entire turnaround thesis over the last few years has been built on abandoning the casual buyer.
Walk me through that pivot. Because for a long time, it really felt like eBay was just trying to be Amazon.
They were, and it was a losing battle from the start. A decade ago, they were locked in this brutal logistics war, trying to convince the consumer who just needed to buy, AA batteries, paper towels, a phone charger.
The everyday essentials.
Right, trying to get them to use eBay instead of Amazon Prime. But that is a commoditized, low-margin game entirely dependent on having a world-class two-day shipping infrastructure.
And eBay doesn't own warehouses.
Exactly. Their sellers shipped the items. They could never win that war, so they changed the battlefield. They literally stopped spending marketing dollars trying to acquire the paper towel buyer.
Okay, so who did they pivot to?
They focus entirely on what they call the enthusiast buyer.
Define an enthusiast buyer in their terms. What does that actually mean?
These are hobbyists, sneakerheads, car restorers, watch collectors. Globally, eBay has about 16 million of these enthusiast buyers.
Okay.
And while the aggregate user base only grew 1%, this specific enthusiast segment grew much faster. In the US market, enthusiast buyers grew by 8%.
Oh, wow.
And the financial footprint of these users is just staggering. The spend per enthusiast buyer exceeded $3,400 annually.
Over $3,400 a year.
Every single year.
That fundamentally changes the math. I mean, if you have a platform full of casual users buying a $5 phone case once a year, you need 1 billion users to turn a profit.
Right, the volume game.
But if you have a platform of dedicated hobbyists dropping $3,000 a year on vintage jackets and car parts, you can build a highly profitable empire on a fraction of the user base.
And furthermore, CEO Jamie Iannone pointed out that their broader U.S. active buyer growth was actually much stronger, hitting nearly 6%.
So why is the global number so low?
The global 1% number is being dragged down by some severe macroeconomic pressures in international markets, specifically over in Europe. But the core economic engine, the high-intent, high-spending American hobbyist, that is expanding rapidly.
Okay, let's transition from the raw statistics to the actual items people are buying, because management kept referring to these focus categories.
Yes, the focus categories are key.
I really want to understand what exactly is driving a user to spend over $3,000 a year on this platform.
So the focus categories represent areas where eBay has a structural advantage, where the inventory is completely unique and where trust is just paramount.
What are the main ones?
The primary categories are collectibles, motors, specifically parts and accessories fashion, and re-commerce.
Okay.
These focus categories, along with consumer-to-consumer sales, they now account for approximately 70% of total GMV.
70%.
Yeah.
That means the vast majority of their business is now entirely specialized.
Almost 3/4 of it.
Let's dig into collectibles, because this sector is behaving less like a hobbyist marketplace and more like an alternative asset exchange.
Oh, totally.
During this quarter, in late February, it was the 30th anniversary of Pokemon. And eBay orchestrated these coordinated events across their core marketplace, their dedicated trading card platform called TCG Player, and a subsidiary called Golden.
Right, and Golden is a very vital piece of their high-end strategy.
Explain Golden a bit for the listeners.
Sure. It's an off-platform marketplace that eBay operates, and it specializes in ultra-rare, high-value collectibles. Think of it as like the Sotheby's or Christie's of pop culture memorabilia.
Okay, the really high-end stuff.
Exactly. And during Q1, Golden facilitated a transaction that set a completely new benchmark. A Pikachu Illustrator card sold for over $16 million.
$16 million?
Yeah.
For a piece of cardboard? I mean, the mechanics of that transaction alone just fascinate me. Because you don't just put a $16 million trading card in a bundle mailer and drop it off at the post office.
Yeah, no, you don't. And you certainly don't wire $16 million to an anonymous username with zero verification.
Right. So how does that even work?
That transaction is the ultimate proof of concept for their trust infrastructure. Golden handles the authentication, they handle the secure storage, and the insured transfer of the asset.
Okay, so it's a white glove service.
Exactly. And when a buyer trusts the broader eBay ecosystem enough to transact at the $16 million level, that institutional credibility trickles all the way down to the enthusiast who's just spending $100 on a baseball card.
That makes a lot of sense. Speaking of the everyday enthusiast, Jamie Iannone mentioned an AI-powered card scanning feature that has surpassed 30 million cumulative scans.
Yeah, 30 million.
I have to admit, I'm highly skeptical of companies just shoehorning AI into their products right now just to satisfy Wall Street. I mean, if I have a rare holographic trading card, I don't want a hallucinating chatbot trying to guess what it is.
And that skepticism is totally warranted given the current hype cycle. But this is a highly specific, deterministic application of computer vision. It's not a generative text bot.
Okay, so how does it work for the user?
A seller simply points their smartphone camera at a trading card. The software uses image recognition to identify the specific card, and then it cross-references it against a database of 30 years of historical pricing data.
Oh, wow.
Yeah, and it immediately provides the seller with the card's current market value and population data, which tells them exactly how many of those specific cards exist in that condition. And in Q1, they expanded this beyond sports cards to cover games like Magic, The Gathering, and One Piece.
I can actually see how that removes an immense amount of friction. Trying to figure out the exact release year and like holographic variant of a trading card, that can take 20 minutes of research on Google.
Oh, easily.
If the software does it instantly, the seller's just much more likely to actually list the item.
And that principle of removing friction applies directly to their next major focus category, motors. specifically parts and accessories, or P&A.
Okay, the car parts.
Right. This division single-handedly contributed roughly 2 full percentage points to the overall marketplace's growth in Q1.
Just car parts.
Just car parts. And the driving force here is a program they call Guaranteed Fit.
Okay. Anyone who has ever attempted a DIY car repair understands the absolute anxiety of buying parts online.
It's the worst.
It is. You order a water pump, you wait 5 days for it to arrive, you spend 3 hours taking your engine apart in your garage, and then you discover the bolt pattern is off by 2 millimeters because you have the mid-year production model. It's a total nightmare.
It really is. And eBay addressed that exact anxiety. So when a buyer inputs their vehicle's make, model, year, and trim into the platform, the system cross-references those specifications against the parts data.
Okay.
If the system gives it the green checkmark for guaranteed fit, eBay assumes all the risk.
Really? All of it?
Yep. If the part arrives and doesn't fit, the buyer gets a full refund, and eBay handles the return logistics.
That's huge.
It is. By mathematically reducing the risk of a misfit, they've seen a meaningful increase in conversion rates, meaning a much higher percentage of people who look at a part actually buy it.
That makes sense.
And they just expanded this program into Australia in Q1, which has a massive car enthusiast culture.
They also made a really fascinating acquisition in the auto space during the quarter. They bought a UK-based software provider called Aladdin Systems.
Yeah.
But what does a software company have to do with selling alternators and brake pads?
Well, Aladdin Systems builds the inventory management software used by physical salvage yards.
Wait, like junkyards?
Exactly. When a car is totaled and sent to a salvage yard, the yard strips it for usable parts. And these are original equipment manufacturer, or OEM parts.
Right, the official parts.
They aren't cheap aftermarket knockoffs. They're the original parts built by Ford or Toyota, just salvaged from a wrecked vehicle.
Good.
So by acquiring the software company that these yards use to track their inventory, eBay can seamlessly pipe that real-time inventory data directly onto the eBay marketplace.
They're literally digitizing the salvage yard.
Exactly. It unlocks a massive supply of affordable, high-quality OEM parts for mechanics, and it plays perfectly into the growing demand for circular, sustainable commerce.
And the strategy goes even deeper than just selling parts. A year ago, they acquired a company called Caramel,
Right, Caramel.
which provides a secure digital checkout experience for buying and selling actual whole vehicles. So they're scaling this tool for consumer-to-consumer vehicle sales and small dealerships. And Jamie Annan made a point about this synergy here that is just brilliant.
The funnel effect.
Yes, when a consumer buys a vintage Mustang or a used Jeep on eBay, that vehicle purchase acts as an acquisition funnel.
It creates a captive audience for the parts and accessories business.
Exactly.
The moment a buyer acquires that vehicle, they embark on a multi-year journey of maintaining, repairing, and upgrading it.
Because it's a project car.
Right. The initial car sale might happen once, but that buyer will return to the platform dozens of times over the next decade to buy spark plugs, floor mats, exhaust systems. The vehicle is just the hook. The parts are the recurring revenue stream.
It is such a smart long-term play. Let's shift our attention to the fashion category because there is a structural change happening here that I find deeply counterintuitive.
The fee changes.
Yes. So consumer-to-consumer sales, or CDC, which is just you or me selling a jacket from our closet to another regular person, makes up over a quarter of eBay's total volume.
Right.
For decades, the standard business model has been the seller can list the item for free, but when it sells, eBay takes a 10% to 15% final value fee out of the seller's profit. And the buyer simply pays the price of the item plus shipping.
That has basically been the law of gravity for online marketplaces.
Right, but eBay is completely flipping the equation. In May, they are revamping the consumer selling experience in Australia, which is their fourth largest market. They're completely eliminating selling fees for consumer sellers.
No fees for the seller.
None. Instead, they are introducing a buyer-facing fee on those C2C transactions. And this is where my skepticism peaks.
I get that. It sounds crazy at first.
It does. If I am browsing for a vintage band t-shirt and I get to the checkout screen and suddenly see like a 5% or 8% buyer fee tacked onto my total, my immediate reaction is going to be to close the laptop. Shifting the financial burden to the buyer seems incredibly risky. Won't that just destroy buyer demand?
It feels risky until you look at the empirical data. because Australia is not their first experiment with this.
Right, they tested it.
They previously rolled out this exact fee elimination for sellers in the UK and Germany, and the results completely defied conventional wisdom. C2C delivered double-digit volume growth across the US, UK, and Germany in Q1, meaningfully outpacing the growth of traditional business-to-consumer sales.
Okay, you have to explain the psychology of that to me. Why doesn't a buyer fee kill the transaction?
It comes down to a concept called the sell-to-buy flywheel, and it's based on the realization that the primary bottleneck for a specialized marketplace is not buyer demand, but unique supply.
Okay, unique supply.
Think about it. Millions of people have high-quality, pre-loved clothing, electronics, and collectibles just sitting dormant in their closets.
Oh, definitely. We all do.
But the mental friction of photographing the item, writing a description, packing it, and then sacrificing a large percentage of the sale to platform fees, it keeps them from listing it.
So by making selling 100% free, you remove the biggest psychological barrier. You convince the casual user to finally clean out their closet.
Exactly. When selling becomes free, it unlocks a tidal wave of proprietary inventory. Millions of unique, one-of-a-kind items flood onto eBay that literally cannot be purchased anywhere else on the internet.
Okay, I see where this is going.
And this is the crucial point. Buyers go where the inventory is. If you are hunting for a specific 1990s Patagonia fleece, and the only place it exists is on eBay because that is where the seller chose to list it for free, you will tolerate the buyer fee.
Because you have no other choice if you want that specific item.
Right. The exclusivity of the supply grants the platform the pricing power to shift the fee onto the buyer.
Wow. And I guess the secondary benefit is that the seller who just made $80 clearing out their closet now has an $80 balance sitting in their eBay account. Human nature dictates they are probably going to spend that money right back on the platform.
The newly funded seller immediately converts into an active buyer. That is the flywheel in action.
That's brilliant.
And look, competitors like Vinted and Depop utilize this zero seller fee model to capture massive market share among younger demographics. eBay recognized the threat and adapted their legacy model to defend their turf, and the data proves the transition is working.
I want to circle back to the friction of creating a listing, because management spent a significant portion of the call discussing their new AI integrations.
Yeah, they're leaning heavily into AI.
We established that the AI card scanner is a practical, deterministic tool, but they're also deploying generative AI to write the actual product listings. They call it the magical listing experience.
Right, magical listing.
Again, having used various AI text generators that frequently output generic robotic nonsense, I have to ask, how is this actually moving the needle for a commerce business?
The difference really lies in the training data. A standard consumer chatbot is just trained on the broad, unstructured internet. It just guesses.
Right.
But eBay's magical listing tool is trained on a proprietary product knowledge graph and 30 years of structured marketplace transaction data.
Oh, wow. So it knows what actually sells.
Precisely. When a seller uploads a photo of an item, the AI doesn't just guess what it is. It compares it against millions of similar successfully sold items. It writes an optimized title, categorizes it correctly, automatically fills in the item specifics like brand and material, and even suggests a competitive price based on real-time market dynamics.
And what are the actual business results? Because, a cool tech demo doesn't always translate to revenue.
Jamie Ahn stated that the U.S. rollout of magical listing has been one of the most impactful product launches in years. Yeah, it has driven a greater than 50% increase in the new listing creation rate among users who adopt it.
50%.
Let the magnitude of that number settle. 50% more listings are being generated simply because the cognitive load on the seller has been drastically reduced. They also noted double-digit percentage increases in sold items and total volume per lister. Over 500 million listings have already utilized these AI tools.
That is incredible. And they're also testing an AI tool on the buyer side, right? Called the agentic search beta.
Yes, and this represents a fundamental shift in how we interact with commerce. For the last 20 years, shopping online has been entirely keyword-driven.
You type blue Nike running shoes size 10 into a search bar.
Right, and you just filter through a grid of images. Agentic search moves from keyword queries to conversational, intent-based shopping.
Okay, so how does that look for the user?
Instead of searching for the exact item, you interact with an AI personal shopper. You might say, I am attending an outdoor summer wedding in Tuscany. The dress code is semi-formal, but I know it will be hot. Find me a vintage linen suit and some breathable loafers.
And it actually understands all of that context.
The AI understands the context of Tuscany summer wedding, cross-references your saved sizes and brand affinities, and curates a tailored selection of unique, pre-loved inventory.
That is wild.
While it's still in early beta, they are seeing roughly 50% more search engagement in sessions utilizing these AI refinements, translating into double-digit increases in purchase behavior.
They're also finding ways to get this inventory in front of users who aren't even on eBay, right?
Yeah.
They mentioned taking a pilot program with Facebook Marketplace and moving it into general availability.
Yes. This means eBay listings are now natively searchable within Facebook Marketplace for the majority of users in the US, Germany, and France.
It is a masterclass in top-funnel acquisition. I mean, Facebook Marketplace has a massive, highly engaged audience looking for local goods. So if a user on Facebook searches for a highly specific power tool that isn't available locally, the platform will now surface a relevant eBay listing and route that high-intent traffic directly to the eBay seller.
It is highly efficient marketing that leverages another giant's user base.
Okay, we have spent a lot of time analyzing what happened in Q1, but as investors know, the market is a forward-looking mechanism.
It always is.
It ultimately cares about what you're going to do next quarter. So let's look at management guidance. What is the outlook for Q2?
Peggy Alford provide the projections. For Q2 2026, they expect GMV to land between $21.3 and $21.7 billion. On an FX-neutral basis, that is an 8% to 10% growth rate.
Okay.
Revenue is projected between $2.97 and $3.03 billion, and earnings per share should hit between $1.46 and $1.51.
Let me do the math on that. Something seems off there. In Q1, the total volume grew by 14%. But for Q2, they are explicitly forecasting growth of only 8% to 10%.
Right.
That is a significant deceleration. If I am holding this stock, shouldn't a sudden drop in the growth rate trigger alarm bells?
In a vacuum, yes, it would. But analyzing sequential growth rates requires understanding lapping dynamics, which is just how Wall Street describes comparing current performance against exceptionally unusual events from the exact same period the prior year.
Okay, so what was unusual about last year?
The Q2 growth rate appears slower artificially because Q2 of the previous year set an abnormally high bar. Two specific events caused a spike last year.
What were they?
First, during Q2 of last year, eBay saw a massive surge in volume driven by their integration with Klarna, the buy now, pay later service in the US.
Oh, right, the deferred payments.
That integration unlocked a wave of deferred payment spending that created a one-time spike in growth. Matching that specific surge a year later requires significantly more organic volume.
Makes sense. What was the second event?
Second, returning to Q1 of this year, there was a temporary massive spike in the sale of physical gold and silver bullion on eBay, driven by global macroeconomic anxiety.
People panic buying gold.
Exactly. Management expects that panic buying of precious metals to normalize and cool off in Q2. When you isolate the core business from the Klarna lap and the bullion anomaly, the underlying momentum remains entirely intact.
And the clearest signal that management is not worried about a slowdown is their full-year guidance. They didn't just reaffirm their outlook for 2026, they actually raised it.
They did.
They now expect full-year GMV growth of 7% to 7.5%, and they upgraded their operating income growth projection to between 9% and 11%.
Which leads us to the final major strategic move they detailed on the call, one that will heavily impact the second half of the year, the acquisition of Depop. They expect this deal to officially close by the end of the third quarter.
For you guys listening who might be outside of the Gen Z demographic, Depop is a mobile-first fashion marketplace. It is effectively a digital thrift store merged with a social media feed.
Yes, very visual, very social.
And it has an absolute stranglehold on Gen Z's secondhand clothing habits.
It's a pure demographic acquisition. But the financial modeling Peggy Alford provided is fascinating. Once integrated, Depop is projected to add roughly 1% to eBay's total growth rate for the year.
Okay, 1% growth.
However, it will act as a low single-digit headwind to operating income, and it will actually dilute their non-GAAP earnings per share by low single digits.
Hold on. They're spending billions of dollars to acquire a company that is going to actively lower their earnings per share.
Yep.
She mentioned this was partially due to foregone interest income. What does that mean exactly?
Well, when eBay holds billions of dollars in cash on its balance sheet, that cash doesn't just sit in a vault, right? It's invested in short-term instruments that generate interest income.
Right.
That interest income boosts their overall earnings per share. To buy Depop, they have to deploy that cash, So they lose the interest income, and they also incur massive operational costs to integrate Depop's technology and workforce into eBay's infrastructure.
But Wall Street notoriously punishes companies when earnings per share drop, even by a few pennies. Why is management willingly taking a hit to their profitability today to acquire Depop?
Because it is a necessary defensive moat-building strategy to ensure survival in the 2030s.
Okay, explain that.
The Gen Z fashion re-commerce market is the fastest-growing sector in retail. Younger consumers fundamentally value sustainability and actively prefer pre-loved clothing over fast fashion. Depop owns that cultural zeitgeist.
So it's about the future user base.
Exactly. If eBay does not capture that demographic early, they run the severe risk of their existing enthusiast buyer base simply aging out, with no younger cohort to replace them. They're sacrificing short-term EPS padding to secure the pipeline of future users.
It perfectly mirrors their strategy in every other category. I mean, they bought TCG Player to lock down the trading card market. They created Golden to lock down high-end collectibles. They bought Aladdin Systems to secure the auto parts supply chain. And now they are acquiring Depop to secure Gen Z fashion.
It's a pattern.
It really is. They are systematically assembling an empire of specialized, high-trust marketplaces.
This brings us to the bottom line. We have waded through the data, the jargon, and the strategic pivots. What is the actionable takeaway for a retail investor evaluating this company today?
My stance, looking at all the structural improvements they have made, is undeniably bullish. The thesis rests on three pillars. First, they successfully executed an existential pivot.
The pivot away from the Amazon model.
Yes. A decade ago, they were the everything store, losing a war of attrition against Amazon's logistics network. They recognized the failure, retreated, and fortified a new position as the high-margin, high-trust haven for enthusiasts. They aren't trying to sell you paper towels. They are selling you the $500 vintage jacket you literally can't find anywhere else.
The second pillar is their exceptional capital allocation. They're a cash-generating machine. In Q1 alone, they produced $898 million in free cash flow.
Almost $1 billion in one quarter.
Right. And they're aggressively returning that wealth to their investors. They have a $2 billion share repurchase target for 2026, and they already bought back $500 million worth of their own stock in the first quarter.
And when a company repurchases its own shares, it physically reduces the supply of stock on the open market, which mathematically increases the value and ownership stake of every remaining share. Add in a healthy $1.01 quarterly dividend, and you have a company heavily rewarding its shareholders.
The third pillar is their resilience to macroeconomic shocks. An analyst questioned whether inflation and a weakening consumer would hurt the platform. Jamie Ayonon pointed out that U.S. buyer growth remains strong at 6%.
Which is great.
More importantly, eBay operates as an economic shock absorber. In a booming economy, people feel wealthy and buy $16 million trading cards and vintage sports cars.
True.
But in a tightening inflationary economy, consumers seek value. They turn to eBay to buy refurbished laptops and salvaged car parts to save money, and they start selling their own possessions to generate extra income. The marketplace functions beautifully in both environments.
Ultimately, deciding to invest in the e-commerce sector requires choosing a philosophy. You can invest in the big box retailers, fighting a brutal, low-margin war over warehouse automation and delivery speeds. Or you can look at eBay, a company proving that you don't need to win the logistics war if you can capture the enthusiasts' trust. They have constructed a formidable moat using 3 decades of transaction data, billions of unique listings, and a deeply entrenched, high-spending community.
It is a remarkable turnaround story. From the chaotic, damp driveway of the early internet to a highly profitable, specialized global exchange.
But looking forward, the implications of their agentic AI search beta present a really fascinating philosophical question about the future of how we acquire things.
It really does. As this AI matures, as it becomes more adept at translating natural conversation into highly curated product recommendations, we might be witnessing the end of the traditional search bar.
In what sense? What do you mean by that?
Well, currently, commerce requires the buyer to do the labor. You have to know the specific noun you want, type it into a box, and evaluate the results. But in an AI-native ecosystem, we transition to intent-based commerce. You won't search for products. You will simply describe the life you want to live. Your aesthetic, your upcoming projects, your exact measurements to an AI curator.
And this will work for you.
And that intelligence will constantly, silently scour the attics, garages, and salvage yards of the entire world, sourcing unique, sustainable items that perfectly match your intent, effortlessly facilitating the transaction. If eBay can secure its position as the conversational interface for the world's unique inventory, the ceiling for this company is exponentially higher than the market is currently pricing in.
That is a staggering vision of the future to consider. Thank you for joining us for this deep dive into eBay's Q1 2026 earnings. We hope this breakdown removed the friction from the financial jargon and provided you with a clear, analytical lens to evaluate the fundamental mechanics of the business. Keep examining the data, stay skeptical of the consensus, and we will catch you on the next deep dive.